One of the biggest shifts in the housing market is happening right now. For decades, if you needed a mortgage, it came from a bank. And chances are it was backed through a government form entity, Fannie Mae or Freddie Mac.
The vast majority of home loans today are backed by the federal government, Fannie Mae and Freddie Mac.
Fannie and Freddie now back about half of new U.S. mortgages.
These programs, we were told, were designed to make housing more affordable, especially for first-time homebuyers. But that system is quickly changing. Today, private credit firms, hedge funds, private equity, and non-bank lenders are flooding into the mortgage market.
Massive private equity firms like Blackstone and Pradium Partners have backed a relatively new breed of homeowner. This growing industry buys or builds single-family homes and then rents them out.
And they're not playing by the old rules. In fact, private credit has grown from $200 billion in 2009 to, at the end of 2023, roughly $2 trillion. That's a 10x growth in 14 years. And by 2029, it's estimated to hit at least 2.6 trillion.
What private credit is, maybe they're not able to get a loan from a more traditional financing institution, and therefore they go to one private credit fund.
This asset class has grown from $250 billion in 2010 to around $1.5 trillion today.
The private credit market continues to garner significant attention.
At the same time, the government is stepping in to privatize Fannie Mae and Freddie Mac.
President Trump himself has indicated that he wants to roll back the government's involvement in the two companies.
Fannie and Freddie private again.
If that happens, there will be major implications for anyone thinking about buying a home in the next couple years. So what does this mean for you? Potentially higher borrowing costs and fewer lending options, and the rise of a renter nation controlled by massive corporate landlords. This video breaks it all down, from the rise of private credit to the privatization of government-backed mortgages, to how Wall Street is going to reshape the future of housing. Let's start with the basics. So what exactly is private credit? Private credit is when non-bank financial lenders, like hedge funds, asset managers, and private equity firms, they lend their money directly to the borrower. No traditional bank involved, no government guarantees, no FDIC backing.
What private credit is, just in its simplest form, is private loans to privately owned companies, privately owned real estate, and privately owned infrastructure.
So it is loans from a source other than deposits, usually to privately held businesses.
This market used to be small, but after the 2008 great financial crisis, traditional bank lenders started pulling back from riskier loans, and that left a huge gap between lenders and borrowers. Private lenders stepped in, and in 2009, private credit was worth about $200 billion, and by 2023, roughly 2 years ago, worth $2 trillion. That 10x growth is only going to ramp up in the coming couple years. Analysts at McKinsey say this is the next era of lending. Brookfield expects this to hit about $2.6 trillion in the next 4.5 to 5 years. This isn't a small side play. It's becoming a core part of global finance. And now it's entering the most personal part of the housing market, residential mortgages. Remember when Jerome Powell came out just a few months ago saying that banks will not lend in risky areas?
Both banks and insurance companies are pulling out of areas, coastal areas and things like that, or areas where there are a lot of fires. So what that is going to mean is that if you fast forward 10 or 15 years, there are going to be regions of the country where you can't get a mortgage, there won't be ATMs, there won't, the banks won't have branches and things like that.
If that becomes the case, who will step in and take advantage of what will be a massive opportunity? Private credit lenders. So how does private credit connect to housing? And why should you care? Until recently, if you got a mortgage in America, there's a good chance it was backed by Fannie Mae and Freddie Mac. These two government-sponsored entities support the entire housing market. For decades, just buying mortgages directly from the bank, freeing up cash for them to continue to lend. This helped keep rates lower than they should have been or would have been. And this is a perfect opportunity for private credit to step in and seize this changing market. Big players like TPG, Angelo Gordon, and others see a $2 trillion opportunity right on the horizon. And home equity loans and non-traditional mortgages. Why? Because banks are retreating. Higher interest rates and tighter regulations and shifting risk models mean traditional lenders are backing off. This leaves plenty of space for private firms to offer lines of credit on their own terms because they are the ones that are going to make the rules. But here's the catch. If there's less available lenders and only hedge funds, private equity firms, and large Wall Street institutions left as the only available option, this means interest rates are going to come much higher. There's going to be more fees and less protection for borrowers. And since they're not government backed, they don't follow the same rules designed to protect consumers. This could not have come at a better time for Wall Street, as $1 trillion in multifamily loans needs to get refinanced this upcoming year, and by 2027, $2.7 trillion worth of debt has to get rolled over and refinanced. As borrowers start to get squeezed and the job market changes, and Wall Street being the only available lender, this presents a massive, massive opportunity for these corporations. And at the same time, Fannie Mae and Freddie Mac are in motion to become privatized. These agencies were taken over by the federal government right after the Great Financial Crisis in 2008.
Fannie and Freddie used to be private companies, but since 2008, they've been under close government supervision.
But now there's a quiet push to hand them back to private investors. And if that happens, it will reshape the entire housing market. With no government support, there's almost no chance we're going to see affordable loan options for most individuals looking to buy a home. And private investors don't need Congress. They answer to their shareholders and they have a fiduciary duty to give them the highest investor return on their capital. Meaning, they are going to pull every penny out of consumers' pockets that they can and pass it along to their shareholders and owners. Experts warn that this is going to make home ownership less affordable and attainable for most people, especially for first-time home buyers or low-income communities. So the question is, if governments are pulling back from housing and lenders are pulling back from housing, who is stepping in and what kind of future will they be building? Here's the reality. A lot of Americans are living paycheck to paycheck right now.
More than half of Americans are living paycheck to paycheck.
Groceries are expensive, gas is expensive, wages are not keeping up, so people are turning to buy now, pay later to make ends meet, financing groceries and gas and even fast food.
So Americans are now using this buy now, pay later apps, which were once very big for purchases like electronics and furniture, to now pay for necessities like their groceries.
Missed a payment on a buy now, pay later installment loan on a sandwich, and it tanked her credit score. That's not just a one-off story. It's happening more and more. These apps don't often report to the credit bureaus unless you miss a payment. Then boom, it hits your credit score like a missed loan. At the same time, credit card debt is skyrocketing month after month.
Americans' total credit card balances now stand at a record high $1.2 trillion.
Just a few months ago, it was at $1.1 trillion. Then it went to $1.12 trillion. Now it's at $1.13 trillion. Delinquencies are rising, and when that happens, credit scores tank. Now imagine this, you're working, you're paying rent, maybe using buy now, pay later here and there, and you want to buy a home. But when you go get a mortgage, the bank says no. Your credit is too shaky, your debt to income ratios don't make sense for them. Your only option? Private credit lenders. But they will not lend their money for free. These firms will take more risk and they'll charge for it. Higher interest rates, bigger down payments, and fewer protections. They're not here to help you get into a home. They're there to make money. And when millions of Americans are locked out of a home mortgage, private credit becomes the last resort, a costly one. So here's the question. If owning a home means taking on more risk, more cost and fewer options, is that still the American dream? Or is that dream being stolen and sold back to us for a premium? If buying a home is out of reach and private credit is too expensive, what's left? Renting. And not just renting from a small mom and pop landlord with a couple duplexes and a triplex. In the last few years, investment firms have been dominating. They've quietly become some of the largest property owners and landlords in the entire country. We're talking about companies like Blackstone, who founded Invitation Homes. And just several years ago, they owned over 80,000 single-family properties. Or Pretium Partners now owns roughly 100,000 single-family homes.
But Blackstone sold their position a long time ago. They own about 80,000 homes.
These firms are managing tens of billions, and in some cases, hundreds of billions of dollars worth of single-family homes. And they buy up these homes and they turn them into rentals. According to Redfin, in some cities, over 20% of homes sold were to institutions and private investors.
Corporate landlords have been most active in the Sun Belt. Corporations bought 28% of all the homes sold in Texas. That figure was 19% in Georgia and 16% in Florida.
MetLife Investment Management predicts that by 2030, the next 4.5 years, institutions, private equity firms, hedge funds, and large investment vehicles like REITs will own 40% of all available single-family homes, and they'll be leased back to the general public.
Analysts write that by 2030, institutions may own 7.6 million single-family rental homes. That could be more than 40% of the market.
Here's what that creates. A housing market where people can't afford to buy, and renting is their only option. But that rental, in most cases, will be owned by a billion-dollar firm.
There's a small but mighty group of companies that lead the industry.
Not some small landlord. These companies aren't just collecting rent, they're optimizing it. They're raising prices, adding fees, automating evictions, and bringing in better systems and technology to increase profits. And in many cases, they're not going to invest back into the communities like a small landlord would. They're extracting value from each and every property. Home ownership used to be the path forward to wealth in America. But if fewer people can afford to buy a home and more are forced to rent from Wall Street, what kind of future does that build? Are we watching the slow death of the homeowner and the rise of a corporate-owned housing system? Let's put it all together. The government is stepping back. Private credit is stepping in. Borrowers are getting squeezed. And corporate landlords are reshaping the entire housing market. This isn't a conspiracy, it's just business. But the consequences are very real. For many Americans, the idea of owning a home is slowly being replaced by a new reality, where renting isn't just temporary, it's permanent.
The people who are buying homes, they're facing a market where homes are much more expensive than they've been in history. And so those people are renting longer. So we have more renters than before, and we have not enough places for them to live.
But if you're thinking about buying or investing, or just trying to stay ahead of these shifts, make sure you're subscribed. We've got more coming. But here's the thing, every shift creates an opportunity. The question is, will you understand the game before it changes again? If you're thinking about investing, buying, or figuring out how to position yourself during all of this, now is the best time to look at where everything is falling, all the dominoes. Everything is pointing towards Wall Street. Everything is pointing towards the investor. I believe the next couple of years will be a massive opportunity for America's middle class that will really basically capitalize on this situation, because there is a lot of opportunity here. I think there's more opportunity to capitalize on this than we've ever seen. This is going to be bigger than 2008, 2009. Look at the stock market Thursday, Friday. Look at it on Monday. Everything right now is delicate. Everything's selling off, and then everything's good again, and it's selling off again. People are concerned. Inside of fear comes massive opportunity. But if you're thinking about investing, buying, or figuring out how to position yourself in this, just pay very close attention to what Wall Street is doing. They're looking at affordable housing. They're looking at this massive shift unfolding with America's middle class. Mom and pop landowners and property owners, they own most of the housing stock. Well, as we start to see this job market start to shake and crack, and we look at what's happening in the stock market, there's a lot of concern, a lot of fear floating around right now. I think this is all going to position, investors well to capitalize on it. Ultimately, this is what's going to happen. If you're renting right now, there are plenty of opportunities to own a home. It just might not be in your market. There's a lot of affordable properties. There's a lot of affordable opportunities out there. It's just likely going to come with sacrifice for some. For me, I relocated my entire family to Ohio, and we've been capitalizing on what I think is going to be a massive opportunity. I think looking back, in the rearview mirror 5 years from now, this will be the best decision I've ever made. But this is what it's going to come down to, sacrificing and positioning yourself to get ahead of it. Because if you don't, I think the world's just going to get harder and harder and harder. Because when has a monopoly ever made things better? But that's what's being formed, and it's not just with housing. It's with many sectors of our economy. AI, automation, this is all going to slowly push away competition, and there's going to be a lot of money that's going to be flowing into assets. You want to put yourself in these assets, and you want to do so unleveraged if possible, or with very manageable debt, because what I believe is going to happen is I think the government is going to print their way out of the deficit they're in. It's going to inflate asset prices, and people that are holding assets are going to benefit, and those that are not are going to be forced to rent from Wall Street and finance things from Wall Street. Those interest rates, I promise you, are not going to be 7-8%. I think they're going to be like hard money loans, or maybe even worse in some cases. What do you think about this situation? Where do you see all of this going? The privatization of Fannie Mae and Freddie Mac.
Proposal that started bubbling up in the first Trump administration, could have a big impact on mortgage demand and housing more broadly. And it's the privatization of Fannie and Freddie.
Banks pulling back. You have insurance companies increasing rates at insane levels in many parts of the country. It's going to push all this to hedge funds, private equity firms, Wall Street. It's going to push all this opportunity to them. Are they going to try to drive down prices or drive up profits? Let's have a conversation below. If you'd like to learn more about what I'm doing in Ohio, you can click the link in the description just below. If you have $100,000 or more in cash, you can click the link, singlefamilyinvestors.com. Catch you next video.